And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal. The full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts. Presented by RIA Advisors.
And welcome to the show this morning. And as the title of the show says, the bulls are back in town. Yesterday, the markets had a very, very nice rally and a lot of good things kind of happening underneath the surface of the market. It's interesting. Just, a couple of months ago, everybody extremely scared, worried about the markets. Now, exuberance is quickly ratcheting up to very high levels. We're back seeing more greed in the markets than not. And again, this is, kind of how markets have been working. But what's interesting is that the speculation in the market is absolutely gone bonkers. S&P 500 call options are just surging through the roof. The number of people trading call options is at levels we have never seen before historically. And again, nothing wrong with that as long as market prices are rising. But I do have a suspicion that at some point in the future, that's not going to work out well for a lot of people, which has historically been the case. When it seems like money's is easy to be made in the markets, that's when markets tend to take it away. And, again, maybe I'm wrong. Maybe this is a whole new paradigm in the market and nothing stops it. It just goes up forever from here and we'll all be happy and we'll all be millionaires. It'll all be fantastic. And I would wish nothing better for anybody in the world than that would be the case. I just have a lot of historical market experience under my belt and I've seen this story play out before, and not to this level, by the way. I've never seen it at this level of speculation in the market where the average kind of retail investor is taking on so much leverage and kind of speculative bets in a lot of areas. I've never seen it to this degree before, not even during, when I was trading stocks back in 1998, 1999, and really heading into the peak of the market in 2000. We saw a lot of speculation back then, but nothing to the degree that we're seeing today. And, it's, again, I'm not saying that another dot-com crash is coming. I'm not saying that at all. I'm just saying that at some point it certainly seems that the amount of risk being taken on by investors in the market will certainly potentially have a more interesting outcome, as my father would often say. If you keep doing that, son, you're going to have an interesting outcome. And that was generally a warning not to do whatever I was doing, like jumping off the house with a bed sheet trying to make a parachute, right? So, that got me in the hospital. Anyway, but it's amazing that us Gen Xers and baby boomers are still alive, considering the stuff that we did growing up.
Experiments with gravity and velocity.
Exactly.
Yeah.
Bottle rocket wars.
Oh, yeah.
Homemade potato cannons.
Gonna put your eye out.
Yeah, exactly. Potato cannons using gasoline, vaporized gasoline. What could possibly go wrong with that? So, anyway, someday we'll have to have the Gen X story hour on the podcast.
X-rated.
Yeah, probably. Anyway, so that's what's going on. Now, economically, data is coming in a little bit weaker than expected. Economic surprises have been coming into the downside. And what's interesting about that is that Goldman Sachs just came out this morning with their GDP forecast for quarter two, right, which is coming up here, at 4.1%. So they're expecting a very, very strong economic print for the second quarter. But at the same time, we're seeing leading economic indexes turn lower. It was down negative 0.1% last report. Inflation is cooling. A lot of the employment data is slowing down. So a lot of the stuff that, is really not, that you would look at relative to what's actually happening in the economy is not showing this exorbitant strength. But the reason you're going to get this stronger than expected economic print is because of the reversal of the trade deficit that we saw in the first quarter, right? Where we had all that front running for the tariffs. That's all been reversed. So that's really feeding into this much stronger print in GDP. So it's a little bit of an illusion. Really, first quarter, which was that negative print in GDP, and the second quarter, this really strong print, is going to be a bit more of an illusion of economic strength than not, just simply because it all has to do around this whole trade balance. But underneath the surface, the economic data is certainly showing some signs of weakness. So we're going to keep a watch on that because that will feed into earnings. Here's what you need to know before the bell this morning. Yesterday, the markets had a very, very nice rally. We gapped up to the upside yesterday right at the open. We were up about 70, 80 bips right at the open. Then the market just had a very nice gradual rise all day long. We were up about 1% by the end of the day. A little bit of a sell-off just right at the end of the day, just a smidge. But that kept us right below all-time highs. So we have all-time highs back here in really kind of mid-February, just slightly above where the market closed yesterday. So we're running into that kind of level of resistance here, just slightly above where markets closed yesterday. But again, this whole kind of trajectory of the market just remains very bullish, very intact, and importantly, what we're watching here also is, don't forget, there was the whole big headline scare that we saw back in kind of in early March, where the 50-day crossed the 200-day moving average. And that was, kind of the big death cross. And it was like, oh my gosh, that's the death cross. You need to sell the markets. This is the bear market's back. And we're now very, very close. Actually, the 50 days crossing the 100-day, but we're going to cross the 200-day here in just a few days, as long as the market just kind of hangs out where it is right now. So again, this is one of those issues that we've talked about before, those death crosses, and we actually did a whole show on that when this occurred. Back then, these death crosses don't always pretend to big, massive bear market corrections. We did that, we did have the death cross and we did have a correction, right? But that pretty much resolves itself pretty quickly. We've seen that repeatedly throughout history. The difference between when the death cross really matters and it doesn't matter is whether or not there's a recession or a financial event of some sort in process. That's when you get that's when the death cross really tells you, hey, you need to get out of the markets. We've got this other stuff going on, very recessionary signals. That's going to lead to much lower prices over time. When you're in a period where markets are actually doing well, your economy is doing strong, you're just having a little bit of slack in the markets for one reason or another, those death crosses are really more buying opportunities on the dip than not. However, saying that, in that context, the NASDAQ, as an example, though, is actually at all-time highs and right now is triggering a golden cross. So that death cross in the NASDAQ has now been reversed on the NASDAQ. So if the NASDAQ rises today, it's going to break out to all-time highs. It's literally right at all-time highs right now. But it's going to break out if we can rise. If the market rallies today some more, you're going to set new all-time highs in the NASDAQ. And if the NASDAQ gets to all-time highs, it's going to drag the S&P with it, because they basically, in the top 10 holdings of both those indexes, they're pretty much the same: Apple, Microsoft, Google, Nvidia. So as goes one, will go the other. And so we're going to see all-time highs in the markets most likely by later this week. However, even saying that, it won't be surprising that if we break out to all-time highs, we're going to see a little bit of sloppiness here temporarily. So again, use any dips in the markets. And when I'm talking about dips, like if you get 1 or 2 days of downside, just a retest of support, like a 20-day moving average, whatever, those are buying opportunities. So buy any pullbacks in the markets for right now, because the bullish backdrop, as I said, the bulls are back in town right now. The bullish backdrop is building for the markets at the moment. Now, it doesn't mean we're not going to ever have a correction again. I'm not saying that at all. We're going to have some more volatility this summer. But again, we're about to move into earnings season. We could see a little bit of slack in the markets early in the month. But as the buyback window opens back up and we start getting things back on toe, if earnings season is in line with expectations, the market should continue to do okay this year. So that's what you need to know before the bell this morning. We'll come back, pick up with Danny Ratliff. We're going to talk a little bit about private equity this morning. Another big push by Republic to bring private equity to market. Also talk about 401k plans. How do you stack up relative to your peers? We'll come back, pick up with Danny Ratliff on that right after the break. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Declare your financial independence from the mainstream financial media and join us for the next RIA Candid Coffee with Danny Ratliff and Lance Roberts, Saturday, June 28th. Know the enemies of your wealth and fight them on your terms. We'll arm you with the information you need. Register today for the Financial Independence Edition of Candid Coffee, Saturday, June 28th with Ratliff and Roberts at realinvestmentadvice.com. realinvestmentadvice.com.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
The Real Investment Show.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So just talking a little bit before the break here about private equity. We've touched on private equity issues before here on the show. And if you go to the website, realinvestmentadvice.com, just type in private equity kind of in the search bar at the top, and you'll see a couple of articles I've written on private equity. Because I don't know why Danny just came in and left again. But you'll see a couple articles on private equity kind of warning you about the pitfalls and dangers of private equity. Now, I'm not saying that private equity is not good, right? Because private equity is a way to generate above average historical returns normally. However, there's a lot of risk to it. And you have to really understand what you're getting yourself into. There's liquidity risk and default risk and all kinds of stuff that goes along with private equity that you need to be aware of. And the number of private equity deals that turn out generating, well above average rates of return are relatively small compared to the numbers that fail. So again, just things you need to know. Well, there's been a big push recently to get private equity into the public market. And one of the lures, not lures, also lures, but also allures of private equity is lower volatilities. Like, I can invest in this piece of private equity and I have very low volatility relative to the markets. Well, that's an illusion, right? Because you buy a house, and this is one of the kind of the big factors about housing is, somebody buys a piece of rental property or multiple pieces of rental property and they go, well, I've never lost money in my rental properties. Well, you don't know because they're not marked to market. So you don't see that volatility that's going on in the real estate market over one period to the next. Yeah, your beginning value and your ending value may be higher than your beginning value, but you didn't see all of the variations of price in the middle, which leads to all the emotional problems that we have as investors in the stock market, where we're, lured into selling at the wrong times, buying at the wrong times because of price volatility. Well, one of the issues is that once you bring private equity into the public market, you now have to mark to market, where all of a sudden you see the volatility. Let me give you a good example. I mean, a really good example of this is just what happened here recently. So at the end of March, the market was down about 10% for the year, right? So we had that. Sorry, that is incorrect. Let me rephrase that statement. That is an incorrect statement. The markets were down about 5% for the year, down 10% from the peak at the end of March. So when you got your statement, you'd be down, your private equity would be down about 5%. You didn't see the plunge in early April, and now you're about to get your statement for the second quarter in June, and your second quarter in June is going to show you basically back to where you were in March. Actually, you'll have a gain because you're higher than you were where March closed. So you didn't see that whole big bump, the Liberation Day effect. It was there, right? Those companies that were operating in the markets were impacted by that, but you didn't see that volatility because it's not marked to market on a daily basis. That will change when you bring that to a public venue. And so because you've got to provide liquidity. If I'm going to make this public access to retail investors, I've got to provide liquidity, and which means that once I provide liquidity, I have to start marking to market. And I don't think that's going to have the effect that private equity players want ultimately. And, and it's going to take away that allure of lower volatility. We're actually going to start seeing the volatility risk in private equity when that comes to market. But but again, this is a really big push right now because private equity companies are running out of people to tap for private equity funds. There's so much demand for it. They're trying to get as many deals as possible as they can to the market. And again, this is another big kind of red flag for you to pay attention to. Before you go buy an ETF or whatever that's investing in private equity, be real careful because the really good deals are going to be kept private by the big firms. So, the people that deal with big private equity companies like KKR and BlackRock and those guys, they're going to have their pool of super high net worth investors where they just say, oh, I've got this really good deal. I've got, the next great, I've got CoreWeave, right, coming, that's private. And I'm going to go to my biggest big money investors. This is a really good deal. This is going to make us all a ton of money here, so invest in this. They're going to do that. The deals that come in that aren't as good, those are the ones that are going to get funneled into the ETFs that get sold off to the private equity market. Because that's the easy way to. It's going to be the ones that the really smart investors don't want. They'll be like, I'm not doing that deal. Okay, well, I've got a whole bunch of retail investors over here that will suck this deal up. Right? So that's the way IPOs work as well. So just be careful with what you're getting to. But this is going to be a big push. The SEC's behind it. Everybody's behind trying to get this to the public market and this idea that, hey, we're going to give more access to the little guy. Sometimes the little guy doesn't need more access. But that's just
that's interesting. I had lunch with a guy who does nothing but IPOs a couple of weeks ago, and he was even talking about the struggle for the average person to get into a lot of these deals. Mm-hmm. Like you can get an allocation, but it will be super small, and you're going to have to really know somebody to kind of get your foot in the door. And so when you talk about even just the private equity market, Bank of America said they're creating 50 new funds every year in alts. And so we've seen this with many different types of investments, right? From crypto to SPACs, where everybody's trying to rush to the market. And now it seems, and so I read a study that says people under 43 have a major distrust of public markets. But yet this private market is now turning public, just what you alluded to.
Right.
And so, there may be, and I think what it is, and the big part of it, there's a big sex appeal to it. That, hey, when we've talked about this,
all right.
And there is a need. I think there are deals and there's very interesting dynamics and structures that can be set up. But for most people, if you're accessing this through a fund or another type of investment, it is not what you would think it would be.
Yeah.
Right?
No, it's true. And, this is, the one thing that we've seen this over and over, this story is played out over and over again throughout history. I mean, we don't have to go back very far. 2020. Everybody's got money to spend, right? We've sent checks to households. You can't go to a casino. You can't bet on a football game because there is no football games. There are no baseball games to bet on. So everybody turns into the financial markets, and there's all this demand for the markets. And as we saw then, you couldn't get IPOs to the market fast enough in 2020. So we had to start doing these SPACs, which were these special acquisition vehicle companies that, you just give me money and I'll go try to find a deal. And then when we know how that turned out, right? It turned out very bad for investors.
The craziest thing about that is you didn't know what you were investing in at the beginning.
Yeah.
They're like, we're going to create this fund to find something to go do.
Exactly. We're going to use your money to do something.
Yeah.
And that just had bad outcomes written all over it. But that was just the symbolicness of the chase by investors. And again, as is always the case, and this is the thing that we've warned you about before, Wall Street is a business. They are not doing you a favor by giving you access to private equity. Right? Private equity has been private equity for as long as I've been in the market, which is 453 years now. And it's always been private for a reason. When there is a massive amount of demand for something and Wall Street finds a way they can make money at it, they're going to figure out a way to make money at it. And they have figured out that, oh, you want private equity? Great. All this other kind of crap stuff I want to get off my books. Guess who gets it? And the reality is that we see this repeated throughout history over and over again, is that right now we've got this massive, I was just talking about in the opening segment, that we have record call option volume going on in the markets at levels we have never seen historically. There is so much speculative demand in the markets right now, demand for risk, capital coming from I don't know where to buy anything and everything that moves in the markets. And so Wall Street goes, okay, here you go. You wanted it. Here you go. We're happy to sell it to you. And again, Danny, I just have a really, kind of bad feeling this doesn't turn out well for investors, as we've seen with SPACs and a lot of IPOs, et cetera.
And the funny thing is, I think if you're listening right now, don't think that we don't like private equity or private credit. There are options out there and opportunities that are very attractive. But when we see Wall Street in general just everybody runs for the entrance of something, that's a problem, right? Yeah. And essentially it's because they're marketing. They're a marketing machine. If you've been inside any one of these big institutions, they are always coming up with what is the new theme, and you'll hear thematic approach over and over and over again. And they'll say, we're going to do this portfolio for a little bit. And usually it's too late because that theme has already occurred, but it's easy to sell because you say, well, look what it did last year. And so that's where you have to really kind of step back, I think, and say, okay, what is the purpose for these funds? My objectives are, and what are the real upside and downside to this? And I feel like there's too many times that we just see something that's shiny and flashy and it's new, like, oh, that's great. We've got to have that. And that is where I think Wall Street wins the game over and over and over again.
And we'll come back. I want to make one kind of final concluding point on this when we come back from the break, talking about most investors under 43 believe that traditional stock and bond portfolios will fail to generate above average returns. That is the stupidest statement ever. Because that's what you get. If you invest in stock and bonds, you're going to get average returns. We'll be right back after the break. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Declare your financial independence from the mainstream financial media and join us for the next RIA Candid Coffee with Danny Ratliff and Lance Roberts, Saturday, June 28th. Know the enemies of your wealth and fight them on your terms. We'll arm you with the information you need. Register today for the Financial Independence Edition of Candid Coffee, Saturday, June 28th with Ratliff and Roberts at realinvestmentadvice.com. Realinvestmentadvice.com.
If you're working and looking to retire soon, a Medicare special enrollment period is in your future. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in penalties. Make sense of Medicare's alphabet soup with RIA Advisors online resources and one-on-one partners to help secure the healthcare insurance choice that is right for your lifestyle and budget and avoid gaps in coverage. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
The Real Investment Show.
Are you a financial advisor sneaking peeks at our stuff? Instead of trying to do it all yourself, why not just join the team at RIA Advisors? Our full-service organization can provide you with the support, unparalleled research, and tools for managing your clients' money and honoring the fiduciary pledge of putting clients' best interest first. Don't take our word for it. Talk to the advisors that work with us. Want to come win with us? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors, big enough where it matters, agile enough when it counts.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
My wife's traveling. She's in Quebec right now for work. She called me up. She goes, everybody speaks French up here. I go, yes, honey. They're a French colony. She goes, I never knew that.
The Real Investment Show podcast. Same show, your schedule.
So the company that she's with took her out to dinner last night. They go to this very nice French restaurant. The appetizer comes out, which is bagua. She goes, that's duck liver, isn't it? Yeah, the rest of the dinner was downhill right from there. So
at realinvestmentadvice.com.
And the only thing that made it better was when they brought the snails out.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN or online at realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now with the new and improved Before the Bell report. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So, just for the break, just talking about most investors under the age of 43 believe that traditional stock and bond portfolios will fail to generate above average returns. That's the stupidest statement ever made. So back when I was investing during the Depression,
And before.
that, yeah.
Well before.
Yeah, exactly. So when you look at historical returns, right, it's like, oh, the average rate of return has been 8%. That doesn't mean that the market generates 8% every single year. That's the average of years. In fact, most years, the market either generates more than 8 or less than 8. And so if you have a stock and bond portfolio, you are going to generate over time the average rate of return. If you invest in private equity, you're going to generate average rates of return over time in private equity. Now, the thought is that if I invest in private equity, I will get above average rates of return in private equity versus what I would get out of stocks and bonds. However, the fallacy in that thought process is that once I bring private equity into the public markets and I have liquidity needs, right? People that now, because again, the advantage to private equity is that once you invest into private equity, you cannot take your money out of it. So it allows the investment to work over time. So a business may struggle for a year or 2 or 3, and this is why a lot of private equity funds have 5-year lockup periods before you can get out of them, because it gives the investment time to work. And this is the advantage of investing in the markets for a longer term view rather than day trading. But it gives your investments time to work, and it gives your investment time to yield a return. Now, the vast majority of private equity investments yield about one-time return over a 5-year period. So your return is actually very low in most cases. The only ones we hear about are the ones that knock knock the lights out. The Ubers, the Lyfts. We hear about those, right? Those companies were private. They went public, and people made a ton of money. Those are a very small percentage of the private equity deals that come to market. However, once I have to provide daily liquidity so that investors can get in and out of these funds, guess what happens to the average rate of return on those investments? They drop to the average rate of return of equity investments in the markets because they're being bought and sold on a daily basis. Every time I have a seller, it's going to hold that price, right? Mark to market. So again, this is going to be one of the this is one of the unintended consequences that will come from expanding the private equity market and making it a public market and giving it access to a whole new, swath of investors over time. Because I've now I have to meet deal demand. And if I have to start meeting deal demand, that means I've got to bring lower quality deals to market just to meet the demand for deals, which means those deals yield less return, which drags down what? The average rate of return in those investments. So in other words, once they do this all sounds great in theory, and retail investors are chomping at the bit. Like, I can't wait to get into this because this will be great. Because right now, the interesting one that's going on right now, and the reason there's a big driver for this is SpaceX. There's a very interesting dynamic going on with SpaceX right now because everybody wants to be in the private equity space for SpaceX. Everybody wants a chunk of SpaceX before it goes public. And it's interesting because there's a whole bunch of different institutions, platforms, et cetera, that are all selling parts of SpaceX on a private basis. And so they were able to get access to shares of SpaceX, and now they're selling them out to their investors, right? So and I'm seeing this a lot. There's a ton of different companies right now that are selling shares of SpaceX. And what's fascinating to that is that's not something you usually see in the private equity market. These deals are usually pretty tightly wound up, and it's very hard to get access to them. But shares of SpaceX are all over the place right now. And people are finding ways to get their allocation of them, then sell them off to their investors. And again, it's going to be interesting to see what the dynamic of that is, because the secondary market for these private shares, which normally doesn't exist, is getting marked up. So people are paying more to get into the deals of SpaceX than what the original valuation was when the people paid into it to get their original allotment. Which means when the deal comes to market, the return may not be as much as expected. It's going to be, like I said, I don't know how this is going to turn out, but this is a very unusual situation with SpaceX that's going on. And it'll be interesting to see kind of how this actually winds out when SpaceX goes public at some point in the future. Danny?
Well, it's interesting. So YouTube, so Peter said it, everybody, it's essentially, where did it go? You guys are too busy on here. It's disappeared on me. Just want to go back here. Just 1 second, Lance.
You're killing the show, man.
Hey,
You're
it's
killing
okay.
the flow.
Killing the flow?
Just go. Okay. All right.
I'm going to wait you out.
Now, moving on to the next topic here. So bond investors right now talking about it's time to stay cool despite heated debate over government borrowing. So, one of the things that Danny and I are going to talk about this. So this Saturday, June 28th, 8 o'clock in the morning, we're doing a Candid Coffee, Danny and I. It's called Financial Independence. I hate the title because it has nothing to do with financial independence. Danny and I are going to talk about everything topical in the markets right now, what's going on, a lot of the narratives, and we're going to be taking your questions. So again, you can submit your questions to us ahead of time. We'll talk about those. We'll be taking questions live in the chat as well. and we'll cover all these. But we're going to talk about the markets. We're going to talk about the economy. We're going to talk about bonds. We're going to talk about Iran, Israel, what's happening, or whatever's going on. We're going to cover those topics on Saturday. So register now. It's this Saturday, 8 a.m. It's a live Candid Coffee with just me and Danny. And so we're going to go through all it's just kind of a mid-year update to the markets, where we are, what we expect to happen going forward from here. But if you want to join in, we'd love to have you. Just go to the website right now, click on the events tab, and we'll see you on Saturday. But again, this is one of the big topics we'll talk about this weekend, is this whole debate over government borrowing, because and I said this before, Danny, is that I thought the big beautiful bill was going to have trouble getting out of Senate, and that's what's happening right now. It's having a very tough time getting passed.
Well, and that's something to be expected, right? I mean, now we're seeing it go back to the House. There's issues there, and there are some non-negotiables supposedly, and on both sides that they say, listen, we're not going to go to the table on this. And now President Trump has said no vacation through the 4th, right? Everybody has to stay.
I don't know if he can debate. I don't know if he has the presidential authority to make them stay, but maybe he can.
I don't know. But, he's trying it. And so we'll see what happens with that. But needless to say, they have to get this done before recess. I mean, if not, there is going to be some issues if you don't get it done by month end of July. And so, we don't want to see this pushed further and further. The main thing that needs to be done with this bill is making this tax code permanent. And there's so many other issues. We've talked forever about how we wish they'd put stuff on like a single page or 10 pages or less.
Just one item at a time.
Yeah.
Let's extend.
And it should be easy. Okay, you guys like this? Boom. Nope. Okay, well, guess what? Now we can use that against you.
Yeah.
Right? Let's play that game instead of saying, well, you may not like this part, but this part's really good. And to get that, here's what you have to do. And I mean, it's just, what a racket. Did you see he's also putting out there imposing term limits?
Yep.
So 6 years for representatives, 12 years for
which I think would
senators.
be fantastic.
Oh, I do too.
The term limit, but again, the problem is that the people that have to vote on term limits are the people that would be term limited
That'll
out.
Impact.
Right, exactly.
Yeah, but
so
half of them are like 85. They shouldn't be around anyways. What do they care?
I agree, but again, once you get into that clan,
yeah, you don't want out.
Right, you don't want out. I mean, you got 5-star dining, you get everything catered to. Why would you ever want to leave that bubble? And plus, you make a ton of money.
Oh, yeah.
When you're in Congress.
Well, I saw it on the state level, actually lobbying for where I did my undergraduate.
Yeah.
And I was just like, it really puts life in perspective very quickly, especially when you see all the big companies and hospitals and all these people lobbying out there. You're like, whoa, okay. And you see who's running things and why. And listen, these guys are getting wined and dined each and every day. They've got, they're in a position of power where everybody wants something from them. And maybe they didn't have that before.
Yeah. No, life is good. So, I mean, that's my whole point, though, is like we've always wanted term limits, but it's just I find it hard that you're actually going to be able to get that passed. But back to the big, beautiful bill. It's stuck at the moment. And this is kind of what I thought would happen, is that there's so many contentious things there. And again, you can only, the margins are not big enough in either the House or the Senate to have major changes to the bill and still get it passed. And again, like I said before, even if the Senate gets this passed, it's now going to have to go back to the House under reconciliation, and they can only lose one vote in the House. So the bigger risk is that the bill gets hung up here for quite some time. And unfortunately, what I think will happen, this is just my prediction, and I could be entirely wrong, and it's fine, because I'm hoping I am going to be wrong, is that this thing's going to get hung up. And we're going to wind up at the midnight hour come September, when we're up against the debt ceiling, and we're going to have to force some type of just kind of blanket continuing resolution through just to get the government funded. And we're going to be dealing with the Tax Cuts and Jobs Act. And that's the big risk here, is that if we don't extend the Tax Cuts and Jobs Act, tax rates go up beginning of next year. And that's going to be an impact to corporate earnings. There'll be an impact to the markets. And I think a failure to get that Tax Cuts and Jobs Act could be a trigger for a sell-off in the markets because of the impact of higher taxes, especially on corporations. Quick break. We'll come back. Get ready to wrap up the show. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Declare your financial independence from the mainstream financial media and join us for the next RIA Candid Coffee with Danny Ratliff and Lance Roberts, Saturday, June 28th. Know the enemies of your wealth and fight them on your terms. We'll arm you with the information you need. Register today for the Financial Independence Edition of Candid Coffee, Saturday, June 28th with Ratliff and Roberts at realinvestmentadvice.com. realinvestmentadvice.com.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
The Real Investment Show.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show. Does your 401k plan stack up against the new national average? Vanguard's annual retirement report sets the mark for what the average person is saving. I was thinking about this, Danny, too, is that may be a little bit deceptive in the statistics, right? Okay. And the reason I say I hadn't really thought about this before, but I was just as I saw the headline that you wanted to talk about this morning. Actually, before I get there, give me a little background on what this article is saying, and then I'll give you my thesis on why I think it might be a little bit skewed.
Yeah, we get quite a bit of this, that comes through. And number one, usually a lot of times they break it down by age group. But, they give you an average, and then a lot of times they don't give you the median. And so the average is typically going to be much higher. And so Vanguard did a study, and essentially this study was done. It's How America Saves. And they pulled 5 million different 401k participants that Vanguard helps. And so the average 401k balance, they said, was up 9% to $148,153. And I think I know where you're going with this. Now, it was skewed because of your super savers, right? The people that max it out, that are making, if you're over 50, making those catch-up contributions, that are very, very good savers. And so what they found was the average employee does a contribution of 7.7%. Overall, it's a 12% contribution if you factor in the employer contribution as well. But what I really found interesting was that they're talking about returns. And I thought, well, this doesn't make much sense because it says the average return was like 13.7% in 2024.
From what period to what
in
period?
2024.
Okay. Oh, okay. Well, that's well lower than the markets.
Correct. But the contribution limit was 12%. The year-over-year number didn't go up that much. So there's some type of disconnect either within the study or within the numbers, right?
Right.
It doesn't make sense. But if you go back to the median and you look at the median balance versus the average, it's only $38,000.
Yeah.
And that's where we talk about there is a problem. There's a saving problem across this country. And I get it, right? I mean, we know all the reasons, right? Inflation's high. It's tough to make ends meet. Wage growth hasn't gone up as much as what you would hope. But there's a big disconnect in here.
Well, and we see a lot of these stories. Fidelity comes out with these same stories, like the number of 401k millionaires. And it'll say there was 138,000 new 401k millionaires this year, blah, blah, blah.
Yep.
Well, when you take that number, divide it by the total number of 401k plans that Fidelity manages, it's 1%.
Correct.
Right. It's which we just get down to the one, the wealthy 1%, right? The type of thing. But no, here was what I was thinking about this morning, Danny, is that when you see these numbers, and I'm not, and you're right. I mean, we know for sure that there's a savings problem.
Correct.
But the one thing that I don't think this takes into account is job changers. Because, so for instance, I had a 401k plan at my previous firm that I had before I came here.
Yeah, that's a good point.
And I rolled that into a SEP IRA, and I have a new 401k plan here. So my balance isn't as high as it would be if I'd put those two 401ks together.
Correct.
Right.
If you're hopping jobs frequently, in fact, I had an email this morning, hey, just switch jobs, old 401k, need to put it into the IRA, right?
Right.
And that IRA is rather large because they do change jobs rather frequently, right? Every several, 3 to 5 years, give or take. And so that does skew those numbers.
Right.
And that's one thing I'd love to see is like, what is the longevity of the average employee?
That was my point. Is what's the longevity of this plan? And I think that would give us, if we had a better idea, it's like, here's every 401k saver that's been saving in a singular 401k plan for the last 10 years. I think that would give us a much better inclination of what they. But regardless of that, first of all, we know the numbers. 25%, 50% of businesses don't have 401k plans. So we can knock out half the people saving a 401k plan right there, employee-wise. Out of the 50% of businesses that have 401k plans, only 50% of the employees actually contribute. We know that stat. So only 25% of the working age population contributes to a 401k plan. And we do know statistically that they're under saving in those plans. They're not maxing them out. So we do know the savings problem is still a savings problem. And we also know
some that aren't they're just not doing it at all.
Exactly. And we also know that we also know, just statistically speaking, from the number of people that can't, don't have $1,000 saved up for an emergency and all this, we know there's an undersaving problem, right? We know that the economy is weighing on a lot of people. They don't have, they don't have enough to save. But it's just interesting, when we talk about 401k plans, because these numbers come out every year. It's like, look, millionaires, how many millionaires in 401k plans? You got to be really careful with some of that data.
No, you do. And then you have to understand, like, what are the other moving parts associated with the 401k plans, right? So a lot of times people utilize them to take loans against them. 80% of plans out there actually allow for that. Now, the good news is only 13% of you guys, and us in general, are utilizing that loan. And so we're not big fans of that, or the hardship withdrawals. And I think, we've talked about it. Richard and I used to talk about it frequently on the Friday show of, all the leakage that you can have within these retirement accounts, where the government's giving us more and more options to take funds out. Oh, use this as your emergency savings funds. No, you need to build that foundation on the other side. This needs to be for what it is for retirement.
Yeah.
And separate those two. There needs to be a separation of church and state when it comes to emergency funds and it comes to retirement funds. And so don't go dip into that. Another thing I found interesting within this was, though, that the average 401k has 17 different types of investments, but the average person was using like 2.3.
Right.
And most people are using target date funds. And my disdain for those things.
Yeah.
Because they're not what we think they are.
Well, and the reason that they're in the target date funds is because if you don't they changed the guidelines, the ERISA guidelines a few years back, and they allowed companies to start auto-enrolling people into 401k plans.
Well, so qualified, deferred, automatic.
Yeah, exactly.
Right.
Well, and if you don't make a choice, you get slapped into a target date fund. My wife went to work with the company that's right upstairs from us. And I was like, honey, give me your 401k plan so I can select your choices. And, she's always him-hawing around. She doesn't really focus on that stuff very much. Yeah. So finally, about 2 years later, she finally gives me access to her plan, and she's in a target date fund.
Do you know what I do for a living? Wait a second.
I don't think my wife really knows what I do for a living. But B, because I'm not an outside party, I don't know what the hell I'm doing according to her, right?
Yeah,
so now if it came from, she knows. I told her the other day, I said, I'm just getting to the point I'm ready to die here and be done with this relationship. And she's like, well, I just know I have to call Danny when it's all over with. So
there you go.
So if you would tell her, she would listen to you. Because
isn't that funny how that works?
Yeah.
And then it'll be the same thing that you've already told her. She'll be like, why'd you never tell me this?
I know exactly the point.
I get that a lot. I know exactly how that goes. Now, especially now that Michelle's in here, she's like, well, I didn't know you were doing this and this. I said, well, I've told you. You either didn't listen or clearly I don't explain it well enough. That's probably what really happened.
Apparently.
But that's interesting, though, because, if you think about it, most people, when they retire, move funds out of a 401k into an IRA. And most advisors are going to encourage you to do so. Now, I can make some arguments from time to time of why you'd want to keep it in a 401k versus an IRA. If you are under 59 and a half and taking distributions, you've retired, you're going to have more access in the 401k versus the IRA. If you're in a state or you have creditor issues where they may not give you full protection depending on the state you live in, there can be an argument there. In most states, you're going to be protected in both. But it's always funny when you see this, and most people want to get out, and then you see they go from one extreme to the other, where you may have the average person has 2.3 investments in their 401k, and then they go to a separately managed account, Lance, and we see these often where there's 400 different investments, and it's like, well, you could have bought SPY. That's just buying the market. And I think you need to understand there's good and bad with both. And the target date funds I don't like, essentially just because they're a little bit misleading. If you looked at a 2025 target date fund right now, you would think it'd probably be super conservative, and it probably has a lot more in equities than what you actually think. And people got burned by that in 2020 and 2022. And so, you always need to know what's under the hood. But it's, 401ks in general, I think, people need to utilize them better. We need to have a better understanding as far as what they do, how they work. And, we can actually, one thing we never actually talk about this, Lance, we can actually manage 401ks. That is something that we have the capability to do. And I don't think,
we don't talk about
we probably don't talk about it ever.
No.
Yeah.
But yeah, I mean, you have, and again, just, you have the option in 401k plans. There's what's called brokerage link. There's a lot of different platforms that are out there that allow advisors to actually access your 401k and manage your allocation better, change your allocations accordingly to the markets, et cetera. So you do have options. Most people don't even know about them. It's just that, normally we just get into a 401k plan. Hey, that's what I'm told to do, so I just do this.
Yep, it's easy. Move on down the road.
But, you are responsible for your own retirement now. It used to be in the day that corporations had pensions and they helped you plan for retirement. That is no longer the case. It is now your sole responsibility to manage your retirement. So you need to do a really good job at it.
Yeah.
And unfortunately, a lot of people don't.
No, they don't. And that's the going back to the financial, kind of awareness 101. As a country, we don't do nearly as good of a job, but we're always, we're being pulled in so many different directions. It's easy. I mean, look, you wake up, you probably get on your phone, and next thing you know, somebody's selling you something already, and you just opened your eyes. And you're getting inundated by it. And so the struggle is real from a savings perspective because we can always be enticed to do something a little bit different. But I'll tell you this, once you start and you do start savings, I can see over and over, especially with younger clients as they've aged, that saving feels really good.
Yeah, they get excited about it.
Yeah, and to see it grow year over year and then get an understanding for the markets and, hey, I'm going to put a little bit more in, I got a bonus or a raise. It's fantastic. It's an endorphin not everybody knows about. You should probably go check it out.
Exactly. All right, that wraps up the show for today. This futures are up right now on the S&P about 13 points. So if we can manage this through the day, we will probably break out to new highs today or tomorrow. So again, we'll see how the market plays out today. We'll be back here tomorrow with Michael Liebowitz to talk all about that, interest rates, all kinds of other stuff that's going on. We'll get with Michael Liebowitz on that tomorrow, and we'll see you on the next edition of The Real Investment Show. Have a great day.